Welcome to Front Range Facts. This is Anthony Meisner.
This is Jim Marion.
All right, let's dive into all things interest rates.
So, folks, look at this: 6.29% interest for a 30-year interest rate. For those of you that don't get this, let me just tell you right now, this is the best interest rates you're going to see for a good 12 months minimum right now.
I mean, since the last 12 months, so it's probably for the next 12 months as well. Jim predicted it last year, and I think he's predicting it again that this is probably the best interest rate we see, which may not be the most optimistic thing for real estate, but it is a good sign that, if you need to get a refi done or you need to get something done, act sooner than later.
Alan Greenspan, has the term irrational exuberance that he's applied to markets. What you're seeing here is the net effect of irrational exuberance. The market saw a terrible jobs report as, the biggest revision in the last 15 years or something. And so it's overcompensated by having money be cheaper than it should be. And the Fed meets September 18th. Here it is, about a week before. You're going to see that the numbers start to go back up once the Fed actually raises, because the market always prices it in advance of those types of meetings. So
it does, in fact. Now, according to what everybody's expecting, this is the likelihood of cuts. Now, 91% of the market is already expecting a cut to happen next week, and there will be no cuts, according to a small portion, which I think is probably very unlikely at this point.
I would not trust those 8.3% of economists who are saying that.
Wouldn't either.
Given the political wins and given the fact the jobs report just really made it an open and shut case to at least give it a try and rate cuts. Mortgage rates, did decline right after that. So this isn't even, hey, the rates have been cut, guys. The Fed's met and they've decided. This is just simply, oh my God, the sky's falling. We've lost, we've added 1 million less jobs than we thought over the last 12 months. So look at how they've overcorrected essentially. And that's why I'm saying that it's an overcorrection, and that's why you're going to see the rates start to trickle back up.
I think so.
And, this is a quote from the chief economist for Redfin, Daryl Fairweather. Today's mortgage rates have already had the anticipated September Fed rate cut priced in. That means when the Fed officially announces the cut, we shouldn't expect a significant corresponding drop in mortgage rates.
Just like Jim has said.
Yeah.
Now, here's an interesting one. 2 expected federal funds rate cuts this year. Currently, we're talking about the first one taking place in September. Jim was telling me a minute ago that October and December are the only other meetings for the year. So that really half of people are expecting another cut at one of those times. But many, many people, far more than we've looked at in the predictions recently, expect cuts in both October and December.
And this has really been driven by that jobs report, that huge leap in the people thinking of 3 cuts.
It really has, yeah. Now, check this out. This is exactly what we're talking about when it comes to interest rates. Right now, maybe the lowest time in the next 12 months, because look at the projections over the next quarters. These guys do know what they're doing, right? As much as, we might be pessimistic or optimistic at times with them, they truly are all about on the same page right now, and it's really setting in at that 6.5% rate for a longer period of time, right?
Yep.
Longer than expected, and it's largely due to those inflation numbers being higher than they need to be.
So we're at 6.29% today. Do you guys see anywhere on there that's less than that? Only once in the second quarter of 2026 does Fannie Mae think it's going to get to that. So if you're going to refi, do it now. If you're thinking about buying something and you've got a home identified, do it now.
Agreed. All right, so this one's interesting. This slide tells me one thing very clearly. In the last 6 months, between Q1 and Q3, home buyers are saying they're more likely to make a move with a higher rate than they were previously. So what this really means is it means buyers are thawing out and getting used to higher rates.
Yep.
And the good news is, if this has made this much of a shift in the last 6 months, the next 6 months could also be a much larger shift. We're seeing it under contracts, we're seeing it across the country, but it's not resulting in sales yet. This is a sort of mindset shift that's taking place.
People have, seen that the rates have been still high. This is the new normal. They're getting more adjusted to that. And, also life happens, right? The reasons that people have to buy become more, difficult to avoid over a longer period of time.
Now, if we look at house payment as a percentage of median income from 67 to current, right? A lot of things have changed, but there's been 3 times in history during that period of time where houses were very expensive.
Yeah.
And we're, of course, in the third one right now. 39% of household income is taken up by housing, and that's just astronomically higher than it should be, right? The average is about 30%, and one was in the 80s when interest rates were astronomical, and of course one prior to 2008.
We're significantly higher, than we have been before, about 25% higher than what the average is right now. And that's the reason why your house isn't selling. That's the reason why you're not getting showings. That's the reason why the buyers are sitting on the sidelines right now. And that's the reason why you're seeing price drops in different, price bands in different areas of the country.
The worst part about this one is this one's lasted quite a bit longer than the other ones. And so I think as we watch that, it's going to continue to be higher for longer.
Yeah.
It's going to take longer to course correct.
That's a good point, because the other ones are nice and pointy.
Yeah, they really are. All right, the recovery is expected to begin next year. I know we all thought it was going to be this year, but very clearly, even at the beginning of the year, we were projecting about a 10% rise in sales, 4 million sales again, and it's actually slightly depressed. Even though Jim and I are sitting here in Colorado, and Colorado's experienced a little bit more buyer activity, the national market has not, and everybody's now finally saying, we'll see about a 12% rise in 2026.
It seems like there's still correction territory nationally, whereas Colorado already seemed to have had that correction, and now it's starting to move back up.
Absolutely.